Every year we invite a presenter to come to campus from a grant called the Lyon Lectureship. The grant was founded by the daughters and the granddaughters of the Lyon family. They're very supportive of deaf culture, supportive of the Rochester School for the Deaf, and RIT. Their goal and mission is to bring successful deaf role models to campus and to RSD to showcase their success for future generations. This has been going on for about 19 years or so. Today, we are thrilled to have Michael Bloomfield with us. He's from Seattle, Washington, so he has flown all the way from the West Coast to see you. Last evening, he gave a presentation regarding with preserving technology. This morning, he visited at the Rochester School for the Deaf and talked with high school students, and to help them prepare and give some advice as to what the real world will be like. This afternoon is your opportunity to learn about investments and what you can do with your money. Michael works for BlackRock. He's an investment company, and it's one of the largest in the world. Probably is the largest in the world. Yep, Michael said it is the largest in the world. And Michael works for them. So he's going to explain a little bit about his background. Michael is a graduate of RIT. So it's really nice to see an alum come back to campus and share his wisdom with you and to share some time with you. Maybe down the road sometime one of you students will be able to come back as an alum and give a presentation. We all want to see you successful as well. So I'm going to stop, and without further ado, I'm going to give it over to Michael, and thank you, Michael.
That's the best introduction I've ever seen. Hey, how you doing? Nice to see you again.
You too.
Let me talk about my background. I work as a developer at BlackRock company for 5 years. BlackRock is an investment company, and they invest money that companies invest for their employees. And when they're doing those financial investments, they have to collect demographic data on the individuals for whom they're investing. And so I work as a database developer and handle all of that information. Today, I'm going to give you financial advice. And my advice is, I'm not a CFA, so I just want to let you know that. Everything I'm going to talk about today, you cannot consider it as financial advice from an expert. I am going to give you a start in your financial literacy, and you'll be taking the next steps and doing more research on your own as it relates to finances and investing. Financing and assets can be divided into 5 categories. There's cash, equities, fixed income, real estate, and commodities. Commodities are things like wheat and soybeans. I'd like to progress down the list. I may or may not cover all of the categories mentioned on this slide. Again, as I mentioned, this is an overview, and this is the beginning of your literacy. So let me ask, I'm sure everyone here has savings accounts. You should have something by now, a savings or a checking account. And so you deposit your money in an account, and you earn something called interest. The more interest you earn, the more money you put in, the more interest you earn. And if you do not touch the principal and you just withdraw the interest, your money will continue to grow. Savings and checking accounts basically work the same way. Both are interest-bearing. Certificates of deposit are money that you deposit in an institute for a time, and then you earn interest on it. Checking account interest tends to be the smallest of the 3 categories. Savings account interest is a little higher, and certificates of deposit has the highest interest rate. Checking accounts tend to have the smallest interest because the money is rather liquid. People can take it out at will. Savings accounts, they can take it out, but you can only usually withdraw money limited time during the month, maybe up to 5 times a month at a financial institution. And for certificates of deposit, there are time limits placed on the deposit. You have to think about the bigger picture and how banks make money. They make money through the loans that people apply for, through car loans. And so when you deposit money in the bank is using your money to loan it to another individual for a purchase that they're making and that they need a loan for. So they don't have all the money that you've deposited physically in the bank. The way the bank makes money is via the loans. The loan interest that's paid back to the bank in part is paid to you through the interest you earn. So you may notice interest rates fluctuating. Maybe you'll say, wow, car loan interest rates are 8%, but I'm only earning 1% on my checking account. And again, it's because you're just getting a part of the loan that the bank is loaned out to another person. And savings accounts work the same way. They have, maximum number of times you can withdraw money. And then certificates of deposit, you must leave the money in the bank or at that institution for the entire length of the age of the certificate of deposit. It could be 3 months up to 18 months. Questions? You don't have to wait to the end. If you have any questions, just raise your hands. This gives you a visual of what I was just talking about. People deposit money into banks, and banks use it to give loans to people. It could be car loans. This could be your future car right here on the bottom, or other vehicles, houses, etc. I'd like to talk about stocks. Many people do not have a thorough understanding of stocks in the stock market. If a company has one owner, that owner earns all of the profit and incurs all of the losses. So if a person starts a business and they invest all of their money and put all of their time and effort into it, and the company earns a profit, that sole proprietor earns all of the profit. So it's one company, one owner, and it's one large piece of stock. Now, suppose there was a partnership. There were 2 owners in a company. One partner, say, footed 60% of the startup fees and 40% was footed by the other partner. Then the profits would be divided likewise, 60 and 40. As more owners enter the company, the profits are usually divided based on the amount of money invested by each of the owners. So in this PowerPoint slide, the first owner is earning 60% of the profits because they've invested 60% in the company. There are many companies that allow you to participate and also invest in them. They may give you 1% available of their entire holdings, and they'll have 1% that they sell as stock, and it's called public stock or public ownership. An individual can purchase a stock, and then you would own that percentage of the company. That's basically what it means. It could be 1%. It's whatever percentage that you want to get of their profit. If it's a small 1%, you'll still be getting profit in that same amount. Let me go back to the sole proprietorship. If somebody were to invest $50,000 at the startup, and then they were to sell it for $125,000, then they would make a $75,000 profit. The same thing is true if you purchase stock. You'll purchase stock at the current market value, and then its worth will appreciate over time. I'm going to shift gears now. Have you ever gone to flea markets and you find something that you like and you negotiate with people. And there are a lot of people at the flea market, and maybe everybody's at the same table purchasing whatever articles or things that are being sold. Okay, hold that thought and keep that in mind. Let's move on to sports tickets. Has anybody ever purchased sports tickets? Have you ever noticed that when a team is in the championships or they're doing very well, that their ticket prices will go up? So, for example, the Cleveland Browns are just stinking this year, and you can tell Dino that I said that. Their tickets are worthless. But as the team gets better, the ticket prices go up. Have you noticed that? That really is a law called supply and demand. If people want tickets, the prices tend to go up. If people are not demanding, they don't have the demand is not that high, the prices will go down. If you think about that with stocks, if companies don't seem to be worth a lot, the price goes down. If companies seem to be worth it, then the price goes up. Often the stock market is valued in the view of public opinion. It's what people think of the company. It's their opinion. But like if you think about Apple, all they do is sell iPhones. But there are other businesses on the market that sell so many different things that other people think they're not worth it. Even though their businesses are awesome, they don't have the marketing that Apple does. And so sometimes the stock prices of these very valuable and solid businesses are not as high as would be valued if valued by a neutral party. Oh, getting back to sports tickets. So suppose you want to purchase tickets online. You can go to a ticket exchange online retailer, and then you can select your seat and purchase the ticket not only for the game that you want, but for the seat that gives you the price point that you're willing to purchase. Ticket exchange, if you look at the word exchange, that's an important word. It's where buyers and sellers come together. The buyers have tickets to sell, and the sellers are looking for tickets to purchase. Now we get to the New York Stock Exchange. It's a very busy place, functioning 8 hours a day. Now, on the slide are all the smiley faces of you people. Here are all the buyers coming in, buying and selling your stocks. And you don't have to know about how the nuts and bolts of the stock market work. You just need to know in general that buyers, people who have stock, come to sell stock, and they sell stock to purchasers who want to buy stock, and they do that through brokers. I have the names of many brokerage firms on the slide, like Edward Jones, Ameritrade, etc. But you would contact a broker, either in person or online, and purchase or sell your stock. Now, suppose you had sports tickets. And so then you have PayPal in order to purchase that ticket. PayPal acts as a broker when you're purchasing your sports tickets. And these brokerage firms act like PayPal when you're buying and selling stock. There are no guarantees in life. Except death and taxes, as we all know. Suppose I were to loan some money to the interpreters. Will they pay me back? They should, but there's no guarantee. Maybe there's a 99.99% chance that they will pay me back, but there's always that fraction of a chance that they will not pay me back. And so the same is true for investing. Now, things may appear as if it's a sure thing that, for example, the interpreters look trustworthy, they have integrity, and they will pay me back. But again, there's no guarantee. It may have a low risk, but there's no guarantee. Now, if you look at number 3, where I say, remember, everything's a risk, especially with Dino. And number 4, loaning money to Dino, definitely not 100% sure. Dino's supposed to be here. He told me he was going to be here, and that point on that slide was specifically for him. I'd like to talk about risk versus reward. High risk and low reward. If you'd really want to avoid that, because if there's a lot of risk and you're not going to get much of reward, it's not worth it. If it's a low risk opportunity, and a low reward, that's like hitting singles in a baseball game. You're making progress. You're not hitting home runs, but you're doing well, pretty steady. Now, suppose you really want the high reward. You want to hit a home run, but a high risk. Those things don't happen often. You know, home runs don't happen in every game and in every at-bat. But the best scenario would be a low-risk option with a high-reward return. And that's what investment brokers look for every day. And that's what investors look for every day. They're looking for the low-risk, high-reward. Now, that's the best scenario, but it's very hard to do. Don't be disappointed that that's not going to work for you every day, because you could find those opportunities that are like the singles in the baseball game, the low risk and the low reward, and they will keep you going. There are two kinds of stock when you look at it. You look at the Apple stock market value. The price goes up, and that's in the growth stage, in expansion. Sometimes somebody purchases a stock, and then after every quarter or maybe semi-annually, the company pays that purchaser a dividend, and that's called a value stock. The stock distributes profits, and it's as dividends. There are other people who look for stock that get paid. I think the interpreter made a mistake. The growth stock is a stock where the share price keeps going up and increasing. The value stock will pay dividends as well. So there are growth and value stocks. The growth stocks prices are often more volatile, and although the price increases, it also decreases as well. The value stocks that pay dividends, there's a sure thing that you'll be getting paid something. You'll be getting distributed profits quarterly or semi-annually, and it's a more stable stock price. There's also a difference between small, medium, and large stock. Large stock means it's a large company, and a small stock might be from Subway. Small stock. A medium stock, let me think. It's an example of a medium stock. Blank. I can't think of anything. Anyway, each category has their characteristics. The larger stocks, the price tends to keep going up. A smaller stock, when the economy's good, the stock is good. Medium stock, it's the price fluctuates. And so it really depends on the business's strategy and how it's impacted by the economy in which it's running. Have you ever heard the phrase, don't put your eggs all in one basket? Because if you have all your eggs in one basket and you drop the basket, all the eggs break, and then your wife gets upset and you have to go back to the store and buy more eggs. Even today, when I go to the grocery store, 20 years later, I've been with my wife. My wife is like, don't put everything in one bag, distribute it on both sides of your body. So I should divide the eggs, half in one bag, half in another. But back to the point, if you put all of your money in one stock, that is not the smart approach. You should diversify. Because some companies' stock prices will be going down while another company's stock price will be going up. So if you lose money in one company, you won't lose all of your money because of that one stock price going down. Buying stock and investing is a lot of money, is a lot of time, and a lot of effort. And an easier way to be involved in investing without having to spend your time and money every day is to purchase mutual funds. Mutual funds is a pool of money that then the pool of money has managers who do the investing, the purchasing and the selling on your behalf. And there's some examples on this slide of companies that offer mutual funds, like Vanguard, American Century, PIMCO, etc. They offer mutual funds that people can purchase. There is over 6,000 different mutual funds that people can buy into. It's remarkable. That leads me to active versus passive investing. Active investing is where people are involved in the decision making, looking for the low risk, high return stocks. The passive investor is looking at doing some math. Let me see. Think of a better way of to explain it. Following the index. What happens is the index will fluctuate, and purchases are made based on specific numbers in the index. Now, individuals might make a mistake. They might purchase when the stock is actually at the high point, and so they purchase it high, and then the stock market goes down, and they've lost money. Whereas the other type of investing, the passive investing, it's more formulaic, and they tend to follow the natural ebbs and flows of the market and purchase following the ebbs and flows. Exchange traded funds are ETFs, and they're just like mutual funds. They are a little different, but the differences are not enough for me to talk about today. And just like you purchase mutual funds through a brokerage account, you would also do exchange traded funds the same way. Can you see this? It seems rather bright. I wonder if we could dim the lights. Can somebody dim the lights? This seems so bright up here. Okay, is that better? Here's a visual of the actual curve that the stock market makes, and you can see this is real-time graphic of the minor changes that are happening in the market, and it's kind of fun if you want to spend some time on a page like this. I just bought one. Very cool. We'll see if I made any money by the end of my presentation.
Thanks, Stacy. She's adjusting the lights. She's my lighting director. Come on up. Yeah, go ahead. Turn those on too. Thank you. Hello, everybody. Back to normal with the lights on. So what should you do? If you have a credit card debt, my advice is pay it all off, because you can't invest and pay off credit card at the same time. So pay off your debt, because the credit card debt will cost much more than you will lose in the investment scheme. So if you have a credit card debt, pay it off. Establish your cash flow that you have to invest, and then you'll be better able to invest in the cash flow. When you work and a company offers a 401k or 401(3)b retirement option, Invest through your employer because it's tax-free and your money will grow at a faster rate. Look for something called life cycle funds in which to invest. It's an easy way to invest. The life cycle funds will take care of matching the stocks, bonds. It will diversify your funds. What I just bought, like with professional individuals, so they know how they are and their age of working and how many years in their profession they will have. If you're at the end of your career, you're not going to take some high risk investing. I tried investing myself and I lost too much money and I thought, forget it. I'm going through the professionals. Let the professionals do the investment. Don't do it yourself. And again, I would recommend investing in a life cycle fund. They will diversify it and they will establish it over your career. You have to really be educated. You have to take the time to look at websites and start reading and become familiar with how to invest and what it entails. Vanguard is an excellent website. E-Trade, they do have pretty good information on their website. BlackRock. Morningstar is another website that has good information that you could read and learn about. If you're adventurous and you really want to learn more, check out thewizard.com.